Good morning. Good morning, everyone. I'm Lori Fay from Locksmith Group, and I want to thank you guys for joining us today for our bond readiness workshop. Okay, so this isn't just about bond readiness, but if you are already bonded, maybe you're going to find some tips about how to increase your bonding, what you should be doing, some information that maybe you're just not aware of. Today's webinar is really designed to help you have a better understanding of bonding in its whole. So we're going to talk about what's needed and required to obtain and then maintain a bonding program. We're going to start with what a bond is and how it differs from insurance. We're going to discuss the roles of the surety agent and how to pick a good one. And hint, that's the same way you should choose all of your circle of professionals. We're going to get into that a little bit because I think that's a very important topic for any small business. And then we're going to get to know how your company is evaluated. Okay, that's the documents that you need to provide. And then finally, I'm going to discuss the cost. Okay, we're going to discuss the cost, how much it costs you. So it's an information pack session, and we're going to be taking questions as we go. As I mentioned, there is a chat box. So I suggest you, I'm going to open up my chat box. Okay, make sure I'm online here. There's a chat box. So you might want to open that up so that you can ask questions as you go along. And we can answer them. And we're also going to be posting information, as I said there. So that's a very useful tool for you. So a quick introduction of myself. Okay, so I already introduced myself as Lori Fay. I am the president of Locksmith Group. We're a surety bond and insurance agency. Okay, so I'm the middle woman between you and the surety company. I started my career 27, no, oh my God, I'm looking at this, it's a little bit old, 30 years ago as a surety bond underwriter. And I worked as a surety underwriter for 3 major surety companies before I became an agent. I mention this because we at Locksmith Group, we do things a little bit differently here. We think of ourselves more than just an agent. We think of ourselves as an extension of your organization. Okay, as your advisor, one of your circle of professionals. We help to create value and we help you grow and prosper. So today, I hope you get a little sense of that. I work very closely with many different agencies. I am a CU Grow mentor coach since 2017 for Columbia University. I teach bond readiness workshops for pretty much every acronym you can imagine: the SBS, the SBA, SOBRO, Hofstra University, the EDC, the DOT. I mean, literally, I could go on and bore you to death. But I want you to know that your questions are safe here. You can ask any questions you'd like. And whatever you ask, if you ask to the panelists and host directly, will stay anonymous. But you can always schedule an appointment with me to get an upfront and in-depth evaluation of your company with no obligation. I promise you that. We do this as a service for at AMC. So please, let's get into it. Okay, we have a lot to go into here. So we're going to start immediately. We're going to start with the basics, what a surety bond is. Okay, because believe it or not, as common as they are, a lot of people don't know what an actual surety bond is. So today we're talking specifically contract surety. Okay, so that's for construction workers, construction companies doing public works, and a contract surety bond is the instrument that protects the project owner. So who's a project owner? For example, the SCA, the MTA, DASNY, they would be a project owner. Again, so it would protect the project owner against losses that may occur from the failure of the contractor to perform and or pay all bills related on the job for which the bond is written. Okay, so you heard that correctly, for which the bond is written. A surety guarantee is job specific and not blanket form. Okay. Bonds are generally required for all federal, state, and municipal public works projects over a certain dollar value. Okay, and these can vary for different obligees. They also can be required by banks that are funding a project, or a GC, a general contractor, or a CM who is looking to protect themselves from subcontractors' failure. Okay, so there are 3 parts to a surety bond. the obligee, the principal, and the surety. And we're going to get into that in a second, because this brings us to the second question. What is the difference between insurance and bonding? So insurance is a two-party contract. Next slide, please, Jeff. This is exclusively between you and the insurance company. Insurance covers a loss without the obligation of reimbursement. Okay, it's broad in its coverage. That is, it covers all of your work under one policy. It's underwritten with various degrees of loss expectation. Like, they generally, when an insurance policy is written, they expect a certain amount of losses for whichever loss or risk pool you fall into. So the company assesses the premium based on that risk pool for which you fall. So for example, if you are an exterior restoration contractor, you are going to have a higher level of risk than if you were an interior contractor, say for painting and so forth. But there is a risk assessment that goes into insurance. And there is also, it is also a two-party contract. So if you go and you get insurance with Geico or State Farm or Liberty or whomever, that is a policy between you and the insurance company. Now, bonding is different. It is different because it's a three-party contract. It is between the contractor, the surety company who is supporting you, and the obligee, the owner, the project owner. Now, before I gave an example of the project owner being the SCA, the MTA, the DASNY, and so forth, okay? So this is a contract between three parties, not two, okay? Bonds are more like bank lines of credit than insurance because you don't purchase a surety bond, you qualify for a surety bond. There's a big difference there. Now, I mentioned this before, and I'm going to say it again. Bond is job or contract specific, okay? A surety bond provides assurance, not insurance, that the contractor can complete the contract and pay all the bills associated. So where insurance would help, would protect you against a loss for property damage or a personal injury, bonds don't do that. Bonds protect that, give an assurance to the project owner that the job is actually going to get done, okay? That the bills are actually going to get paid. Those are items that insurance does not cover. So it's assurance, not insurance, okay? So unlike insurance, and what truly sets a bond apart is that bonds are underwritten with a 0% loss ratio expectation. Now, I talked about how insurance is written on a risk pool. Bonds are underwritten for your specific company, and they are underwritten with a 0% loss ratio expectation. Now, the surety may look for losses incurred to be reimbursed by the contractor. So if there is a contractor failure, it could look to you to reimburse them. So I have an anonymous question, and that is, does the EMR increase or decrease the cost of surety? Neither. The EMR is a rating that is a workers' comp rating, and that is has nothing to do with bonding. Now, if you have a very low EMR rating, it's probably going to show up in other areas, and that may end up affecting your overall financial position or your contract abilities, and that could maybe impact your company overall as in a whole and impact your bonding. But an EMR is completely separate from bonding because that is a workers' comp rating. So I'm going to keep going. Next slide, please, Jeff. So where does Locksmith Group fit in, right? Because I talked about a three-party contract, the obligee, the contractor, and the surety company. But where do we fit in, right? We're not a part of that in contract, but we are the middle man or woman in this case. And we're part of your circle of professionals. We are your liaison. We're your middleman between you and the surety company. We play a very important role in representing your company in the proper light and the proper surety to obtain a line that suits your needs. Now, this is your circle of professionals, and this circle of professionals is very important. I don't care what business you're in. If you are in the business of manufacturing, if you're in the business of working for a hospital, whatever it is, you should have a circle of professionals that has expertise in your business. Now, that includes your attorneys, your banks and lenders, and your accountants and your CPA, because these people, and obviously you're a surety agent slash insurance person, right? And the reason why that's important is because contract construction is very specific. All of these people should have expertise in construction. It's really important. We're going to go into the next slide where we talk about that a little more in depth. So let's talk about the surety bond agent. We perform the initial pre-qualification of the contractor. We are the primary surety company contact. You do not communicate directly with the surety company. You have someone who is versed in deciphering the information and submitting your account in the best light possible. We also can provide you guidance. We provide you sound business advice. We are your trusted advisors, right? We send your information once we get it in the format and in the best light we can possibly. We often will get information from the contractors that should not go to a surety company. It might be a QuickBooks statement that doesn't match your fiscal year end CPA statement. We will evaluate that, review that, and be able to communicate with you and your CPA about the right information that should be submitted. See, that is the difference. And that is why a good surety agent needs to understand your business, because all contractors are not the same. An electrician is different than a roadway contractor. A roadway contractor has tons of equipment, and that is what fuels the company and the working capital, whereas an electrician has high labor costs. There is a huge difference in evaluating those two types of companies, right? An HVAC contractor might have contracts that have heavy amounts of material. So you need to have people, all the people that I mentioned in the circle of professionals that really understand your business, very important. And in the next slide, we're going to talk about how to choose those people. Now, this is not just about choosing a surety bond agent. It's about choosing your entire supporting professionals. You want to pick these people carefully, right? And how do you pick these people carefully? Well, you should ask them questions. Look, they're asking you questions, so you should be asking them questions. And the types of questions you should ask are, how many years have you been in business? In the business, you know, for Locksmith Group, for example, Locksmith Group was formed 6 years ago. However, I have been in the business for over 30, just about 30. I think 30 passed in February. I can't believe it. I feel like it was yesterday, right? So you want to make sure that they have been in the business for a substantial amount of time. They understand the business and so forth. You want to make sure that, again, they specialize in construction, contract surety. Look, some agents say they handle surety, but they really have limited knowledge. And usually they're going to a second party. So they're going to they're sub-brokering your business, and you're now two brokers away from the surety company. They don't know the right questions to ask. They're playing phone tags all day long. They're using subpar surety companies that might be, you know, less than A rated and so forth. You don't want that. So you want to make sure that they represent companies in similar size and scope to yours so that they understand your business. But more importantly, you want to be sure that they have the surety companies that you need. You want to ask them, what surety companies do you represent? Do you have access to, that you are the power attorney of? That you are the power. See, if a surety agent only has one or two companies that they represent and have power of attorney to, then those are the ones they're going to try to put your account into. They might not fit. So it's like how many pairs of shoes do you have in your closet? A size 7 and 8, but I have a 9 foot. So they're trying to shove you in there. That is not how you want to have your company represented. You want to be able to have many options. You want your agent to be able to create a sense of competition for your company, because that's really important. But the most important thing is, do they have the ample experience and knowledge to support you, right? So I'm going back to the critical part of, do they specialize in contract surety? Do they represent companies that are similar in size and scope? And then do they have the companies that you represent? But also, do they have ample and knowledgeable supporting staff to respond to your needs and requests? I'm sure all of us as business owners have had that experience where, the lawyer is a one-man show and you call them and they're on vacation and you got to wait a week before you can get an answer. You should have people that have knowledgeable and ample supporting staff to represent your requests, especially in contract surety world, because you know how you guys are. You always come up with a last minute request and we need to respond quickly. So these are all the questions you could and should ask of the professionals that you do business with. All right, moving on again. Now, I just want to be sure we all know what a bond is and who the parties of a bond are, right? You should also, at this point, know how to pick proper representation, how to vet the people that are in your circle of professionals. If you have any questions, please post them now. Before I move on, I want to be sure everybody has the complete understanding. However, if you also would prefer to have a one-on-one with us, you are more than welcome to schedule an appointment. Jeff will post at some point, if not now, a way to schedule an appointment with Locksmith Group. Our website is also made to give you a great deal of knowledge. It is not designed to be a sales platform. It is designed to be an educational platform. So I encourage you to go to locksmithgroup.com if you have any questions, if you need any forms, if you want to look at how your company is evaluated. Jeff is also going to post as we go along some of the items that you're going to need, but this is a good time to ask questions. All right. I don't have any questions, so I'm going to move on. What are the 3 most common bonds a contractor requires? So the first is a bid bond, and there's a huge misconception around what a bid bond is, because this bond is generally written with a small penalty value of 5 to 10% of the estimated contract. But what you have to understand is all of the underwriting goes into the bid bond. You see, this bond provides assurance that the bid that you are submitting is submitted in good faith. The purpose of this bond is to guarantee, it's a legal obligation, it is a guarantee to the obligee, the contract owner, SCA, MTA, DASNY, and so forth, that if you are the lowest responsible bidder, you will honor your bid price and provide the necessary payment and performance bonds as you enter into the contract. So it is a pre-qualification. Now, a lot of people will come to me and say, look, I have a bid that is going in and the estimated contract value is $2 million, but it's only a 10% bid bond. So I need a $200,000 bid bond. No, that's not how it works. We underwrite the $2 million contract because that is just the penalty value. And it's really important to understand this. Now, what is the penalty value? How does the penalty value work? Well, if you were the lowest responsible bidder and you were awarded the contract and asked to provide the necessary payment and performance bonds, and you decided, I don't want to do that. I don't want to go into that job. I decided that there are different opportunities, or I decided, my project manager, is on vacation that week. Whatever the case is, you decide not to go into that. Well, that's where the penalty comes in. So the penalty value of 10%, as we used in this example, of $200,000, you would be responsible to provide that penalty value or the difference between you and the second bidder, whichever is more. Now, most contracts, bid bonds say it is the penalty value or the difference between you and the second bidder, whichever is more. Some of them say whichever is less, but we should always go with the concept of more conservative and understand that that could be your penalty. Now, the bid bond would cover that, but again, the surety company will require an indemnification. We're going to get into that in a second, but they will look to you to pay those losses. So if they have to pay $200,000, you can be sure they're going to come after you. So it is very sure when you're bidding a job that you are going to be able to perform that contract according to its specifications and within the time allowed. Because once you are awarded, you're going to have to present the performance and payment bonds. Now, let's talk about these two bonds. The performance and payment bonds are two very different bonds, but they are generally provided in conjunction with each other. Okay, but they have two distinct obligations. The first is the performance bond. Okay, this guarantees to the owner that you, the contractor, are going to perform the job according to the specifications and within the time allowed. Okay, very important. That second part is very important. So you can't decide, well, I think the height of this wall should be 8 feet and not 10 feet. No, I decided to think that this brick is a different color than they're asking for, but it's a little cheaper, so I'm going to use this. No, doesn't work that way. I want to extend the pipe or make a shortcut here. No, it is according to the specifications, but also within the time allowed. That is what the performance bond is guaranteeing. So you have to be sure that you understand or can at least have a good estimate of when the job is scheduled and what the time to complete is. Is this job a 2-year job? Is it a 1-year job? Or is it a 6-month job? Does it fit into your schedule? And more importantly, can you afford to do the work? Because the second half of the job bond is the payment bond guarantee. And that is guaranteeing that the contractor is going to pay all associated costs, including the laborers, subcontractors, and suppliers that are related to the job at hand. Now, if you aren't aware, you should be, that unfortunately, when a contractor enters into a public job, they generally have to finance the start of the job. Okay, so it is going to be 30, 60, sometimes 90 days before you are able to submit a requisition and get reimbursed. So it's very important to be able to understand what those costs are going to be, what your startup costs are going to be on that job, because you are going to have to finance that in order to put in a requisition. So I know there is a lot of information that we have posted, and I'm going to answer a question. Thank you so much. There is a surety bond all year long, or is it as needed? So again, a surety bond is job specific. Okay, so to answer your question, it's as needed. It is not an insurance policy that is blanket in form. When you bid a job, when you get a job specific, you provide a bond for that job. Now that bond is non-cancelable. So it follows the job for the term of that job. So say you enter into a contract with the SCA and it is a 2-year obligation. That bond will follow that job for that time period. Now, if the job happens to get extended and keeps getting extended and it goes into 2.5 years and so forth, the bond doesn't cancel. It follows that contract. Now, let's say during the interim, you get another job. Well, there will be a job specific bond for that contract. And that specific bond will follow the contract for that job and that term. So it is as needed and it is job specific and for the term that job is. Now, if I haven't answered your question, let me know, or if you have a follow-up question to that before we move on, please let me know. But that is an excellent question. Thank you very much. As we move on, we're going to talk about what is needed to get a bond. Okay, because as I said before, a bond is not insurance. You do not purchase bonds. You qualify for bonds. So how is it that you qualify for a bond? Okay. I'm not going to lie. It's a lot of information. In order to establish a surety line of credit, in most cases, the surety company is going to require an extensive amount of information from you. Now, doesn't have to be daunting. We'll work with you and hold your hand. And hopefully, as you, I always suggest to people that they should start a file on their desktop that's called surety needs. Okay. And as you go along, you build this file so that you always have it and have it handy for yourself, right? The first info for oh my goodness, I just got tongue twisted. The first and most important information you are going to provide is your corporate financial information. That is why it is so important for you to be on top of your finances. Look, I always say, you can't build anything without a solid foundation, and your solid foundation is your financials. Okay. The surety company is going to require 3 years of financial documents. Now, ideally, you are going to be able to prepare and provide 3 years of CPA prepared financial statements. Okay. And the most recently prepared corporate tax return. Now, I know everyone doesn't have this yet, and that's okay. But as you grow, it is important to establish that relationship and work towards getting a CPA prepared financial statement. Now, there are a couple of different types of financial statements. Sureties generally require financial statements to be prepared on the percentage of completion basis. They should come complete with notes and schedules. Now, Jeff is going to post in our chat box a worksheet about financial statements. And it is going to tell you what these terms mean. What's the difference between a compilation, a review, and an audit, and so forth? What is the difference between the basis, a cash basis versus an accrual basis versus a percentage of completion basis? These financial terms are very important for you to become knowledgeable, because as a knowledgeable consumer, you will be able to have better communication with your CPA. Okay. But that's what a good agent is for as well, right? So again, as we are the middle man or woman between you, your liaison between you and the surety company, we will also help you and be the liaison, an extension of your organization, right? To work with your CPAs to be sure that you are getting what you need and on the right basis for the surety companies. It's really important. So as you are coming up in your abilities to do public work, you might not have these financials. Okay. And that is okay. We can try, depending on what your needs are, to work with internal financial statements, like a QuickBooks financial statement or a compilation. We can also start with your tax returns. Now, this is as depending on your bond needs. But again, a proper surety agent will guide you on what is needed as you are growing. Very important, right? The second, it's very important and critical in the evaluation, is the contractor's questionnaire. Now, a lot of people poo-poo this. Oh, it's a questionnaire. Yeah, I thought the same thing, but that's not true. The contractor's questionnaire is where we learn about your business, okay? When you fill out this contractor's questionnaire, you should be filling it out completely and in the best light that you can, right? So don't scribble it in, type it in. We have a fillable form that's online in our Let's Get Started package. Jeff will post that eventually. But we want you to broaden our knowledge of your company with things like capability statements, brochures, company outlines, resumes. Let the surety company really get to know you. Now, all of this information, by the way, is whether you're bonded, unbonded, or already established a bonding program and you want to grow in your bonding program. How do you grow in your bonding program, right? Well, that is by letting the surety company get to know you, letting them see that you are a professional organization and that you have the people and the wherewithal to handle bigger and broader jobs, right? That is what's critical. If you don't want to be a stack of paper on an underwriter's desk, you want to be an organization that they can get behind. You want to have the meat and potatoes, right? You want to really encourage them that you know what you're doing. And by providing additional information, you're going to get that additional support. Okay. The next is your banking, right? So banking is really important. If you walk away with anything from that today, you should establish a relationship at your bank. Okay. Develop a banking relationship with that man or woman that's sitting at the desk and get a line of credit. I don't care if that line of credit starts out at $25,000. It is very important to the growth of your company. You might say, well, I haven't needed a line of credit. I get it. I haven't needed a line of credit either. However, it is important that the surety company can establish that you have the wherewithal to get money if you need it, if you come into a pinch in working capital, that you have somewhere to go and it's already established, because you don't want to go to a bank when you need it. You want to establish that relationship before you need it so that you can grow the line of credit and you can grow your capacity. It's going to be important in your growth of your company. Okay. The more they also, the surety company kind of looks at that as, oh, they've got a good bank. See, it's another level of establishment, right? They're saying, oh, okay, they have a bank relationship and the bank is behind them. That is telling me that they're a good risk. All right. So the company is also going to require personal financial statements and tax returns. Okay. So this is primarily to detail if there are additional working capital resources. Do you have money personally to help the company if it should be needed, right? But they also want to see if you have high debt that they should be concerned with. Okay. So it's important to keep your personal finances in order as well, right? Because if you do have high debt, if you do have credit problems personally, well, what would be the logical course of action for you to solve those problems? Buy your company, right? Buy your construction company. And so that can put a burden on the construction company that you would not want to otherwise have. So by establishing good credit and personal finances, you are also increasing your surety credit. It's very important. Now, the next thing would be your certificate of insurance. There are many obligees owners that have their own insurance. However, it is very important to have good insurance of your own, because if you don't have good insurance, your company could be sued directly, and that could impact the finances of the company. So you want to make sure that you have proper and adequate insurance protection. Again, another reason to make sure that you have a construction specialist insurance agent. It is so imperative because insurance on the construction sector is so complicated. It really is very complicated. And there are so many exclusions that you might not be aware of that are very important to have. Now, last but not least is a continuity, a contingency plan that if, knock on wood, God forbid, something should happen to the upper management, you have some place that your company, some plan for your company to continue its operations. If you don't, the company could stop and everything that you worked for could actually be lost in a very short period of time. Okay. You could default on bonds and you might not have the management to continue. This could be the case of, look, we just went through a major pandemic and there were people that were hospitalized, sometimes for weeks, sometimes for months, and some unfortunately passed away. So they didn't have these contingency or these continuity plans. Their company went right south, and we don't want that to happen. It is very important to make sure that you have this in place to protect the assets that you've worked so hard for and that your family is taken care of in a situation like this. Very important. Okay, so thank you, Jeff. We posted in there a Let's Get Started, which is a link to our website that has all of this information on the website. It also has a full list of documents that you need, a surety submission checklist, it's called. Take a look at it. If you have any questions, you could always book an appointment with us, which is farther up in the chat, but let's move on again. If there are no questions, I'm looking. Nope, we are good. All right. So that's a lot of information that you've just provided to your surety agent. But what does it mean, right? What does it mean? How is this information being evaluated, right? So the surety company is going to evaluate you on 3 terms. It's called the 3 C's of surety. The 3 C's of surety are your capacity, your capital, and your character. Okay. So let's talk about the capacity specifically. The capacity is your ability to perform the obligation at hand based on previous job performance and history. Okay. So we evaluate a lot of times, like I asked before in the contractor's questionnaire, you're going to be able to provide information and they're going to look at those jobs. What is the largest job you've ever completed? What territories do you operate in? What is your largest backlog that you've ever carried? Do you have the necessary equipment to complete the work on hand? These are all things that are very important in order to determine what the next job is for you, right? So if you've only completed a job that is in the $200,000 to $400,000 job capacity size, right? Well, they're not necessarily going to give you a $2, $3, $4 million job, right? You've got to build yourself up. And I said not necessarily because, of course, there are always extreme situations and that growth makes sense. However, in most cases, you are working your way up to build your capacity. Very important also is your internal controls. Now, I told you before, when you're asking your circle of professionals, who's handling the inside of the business, right? I call this anyway, the backstage, right? I think of it as kind of like a Broadway play. I don't know. That's my analogy I use in my head. The front end is you working on the job, your capacity to run projects. However, the back end, the back show is the ability to do all the paperwork, right? So you're estimating your cost control, your project management. Those are all really important. Your internal systems are also really important. Your administrative and office help is very important because we can't, as business owners, we can't do everything. So you've got to have a good back office, a good back show as well as the front show. So then we go into the capital. The capital is your financial position to cash flow you the current work program. I mentioned this before that you are going to be responsible to finance the first 30, 60, 90 days of a job, right? And so the financial capacity to cash flow this is your working capital. That's your current assets minus your current liabilities. It's also the net worth of the company. It's also how much equipment you have, the value of that equipment. I used an example of a roadway contractor. A roadway contractor uses his equipment as working capital versus somebody who has a high labor component. All right. But it's also your bank line of credit, as I went into before. This helps us evaluate your ability to cash flow. Now, very important part of this is when they're evaluating, they're not just evaluating one job. They're evaluating all the jobs that you have on hand, including your unbonded work. Because all of the work that you have on hand puts financial pressure on the company. Okay, so it's important that they can understand that you have the financial capacity to handle all of your workflow. Now, last but not least is the character. That is your reputation. That is the history of fulfilling your obligation. That is your credit. That is, do you have suits or liens or you haven't paid your taxes? That is all part of the character. Okay. We look at, do you have reference letters that say that you've worked for? Do you work with good quality subs and so forth? But it's also your credit. And I'm emphasizing that because a lot of people fail to realize that their personal credit is going to affect the company. Jeff is going to post in the chat box something called the 3 C's of surety, which is something that you can print out, save, so that you understand how those different C's are evaluated at any given time. But we're going to move on again, and we're going to talk about, once you've established a bond program, what you're going to need to update the surety company on a regular basis. Now, again, This is really important because a surety program is not one and done. It's a constant moving program. As I mentioned before, they're job specific, right? And you're always getting jobs and you're always moving. Your bond program is not just set in stone and that's it. You're going to hopefully be moving in the right direction and you're going to be moving up in bond credit. However, you can also move down in bond credit if you are providing the information on a timely basis, if you are having losses, if you are having difficulties. But I will tell you, it is very frustrating as a surety bond agent when I have a good established bond program and the information does not come in a timely basis for me to update the surety. The sureties have rules and regulations. They are required to constantly update their programs with 2 financial statements a year. That would be your fiscal year end, which is generally due by March 31st, people. That is 11 days from today, and an interim financial period, right? Now, the interim financial period is generally the June 30 date. However, that can vary. That can vary depending upon your needs or the type of work you do or what your bond program is at the time. The quality and timing of these may differ according to your needs and programs, and that not the year end. The year end is set in stone. That needs to be provided in a timely basis, really before March 31st. But the interim financial can vary depending on your needs. Generally speaking, the rule is June 30th. However, again, if you're a landscape contractor, you're going to show a better quality financial statement in September, right? So you're working a lot in the summer and that financial statement is really going to show a more accurate financial picture. That may be the case for you. You're also going to provide annual tax returns, annual personal financial statements, annual personal financial tax returns, okay? Very important that you also get those done timely. Look, at the end of the day, what I always say to people is, does your accountant give you a discount if he or she provides your financial statements late? No, they don't, okay? So get them on time. Insist that you get them on time. And if they can't give them to you on time, get a new accountant. And I'm dead serious about this. Now, you have to do your part because you have to provide a lot of information, but that's really important because it is costing you money. It is not helping you, even when you have a loss sometimes, even when you're having an issue on your financial statements, it is still beneficial to have those documents in hand because your surety agent can then take control and maybe switch your program or get help in a program such as the SBA bond readiness program. Okay, so whether you're having a loss or not, it is not going to help you to delay the getting of those financial statements and tax returns. All right. So we want to be sure that you're on time with those. Now, going during the year, I know it can be daunting, but we're often going to ask you to update your work in progress schedule. That's the list of all the jobs you have, the current costs that are on the date, the current billings that they have on the date and so forth, your current cash balances, and maybe your line of credit usage. Now, these are generally required once a quarter, but sometimes we ask more often because maybe you're working so quickly on a job and we want to get updated so that we can get you more work and so forth. So, be prepared to update those. They shouldn't be too much of a difficulty. Everything's online these days. So we want to make sure that we're constantly keeping your file up to date and your program in place. That's what's so important. And again, I'm just going to back up and reiterate that even when you're having a bad or a difficult year, provide the financial statements so that we can switch. Your agent can switch the program for you and still get you bonding. Having no financials is not going to get you bonding. Hiding those is not going to get you bonding. I promise you that. Okay. But a good agent will go into action to keep your bonding going. All right. Next, once a bond program is approved and established, regardless of the level of support you are granted, it doesn't matter if you got $100,000 bond or $100 million bond, you are going to have to sign something called an indemnification. An indemnification is a hold harmless agreement. This is where I talked about how you would reimburse the surety in case there are losses. Now, this agreement needs to be signed by the corporation as well as all of the shareholders and their spouses personally. Now, don't be mad at me. I don't make the rules. And unfortunately, this is a condition that is non-negotiable and is required for any and all bond programs. So yeah, you heard that right. You are going to have to sign corporately, but you are also going to sign personally, and your spouse is going to sign personally as well. Now, there are always exceptions to the rule, very few and far between. But there can be, like, say, for example, your spouse is a doctor and she is part of a practice. We may be able to exclude her personal assets that are part of that practice and so forth. So there can be certain exceptions, but for the most part, any and all bond programs require that. All right. By the way, you sign an indemnity agreement all the time. When you buy a house and you have a mortgage, you sign an indemnification. When you sign a credit card, you sign an indemnification. That is something when you buy a car, you're signing an indemnification for that loan as well. So this is a very common thing that you probably have signed a million times and don't even realize it. All right. No questions. Moving on again. What are the cost of bonds? Now, I'm sure everyone wants to know this, right? Because they can vary and they can be different, but it's a very important question. And it's very important that you know the cost before you bid the job, okay? So that you can incorporate the cost into your estimates, right? You need to know all the costs that are associated with your bond program, because this can vary, and it can vary by surety company, class of business, assessed risk, and the contract, or even the job. I mean, there are jobs that, sometimes there are jobs that are, more complicated and are easier, and you can actually get a rate break. For example, I have a contractor who's got two rates. He's got a rate for his construction, his general construction, and he's got a rate for his tree planting. So you can have two rates on an account depending on the type of work it is. But typically bond premiums are based on the contract value. Okay. They are 1 to 3%. Now, the good news is with Locksmith Group, that is, there are no charge for bid bonds. There's generally no charge for a bid bond. Okay. And sometimes you can have 20 bid bonds in a year. I mean, I've had a client who's had 50 bid bonds in a year, and there's no charge for those. That's allowing you to bid the job, and that is part of the pre-qualification program. There can be exceptions, as always, for charges on bid bonds when you are the lowest responsible bidder and the bonds get waived, but that's a conversation for a different day. For most part, there are no charge for a bid bond. Now, the payment performance bond, they generally go together and they're priced together. There's one charge for both. You get charged this premium once the job is awarded and the payment and performance bonds are required. Now, the cost of these bonds are generally speaking, 1 to 3% of the contract value. Now, for smaller starting out companies, you're going to be on the higher side of that rate. There's also things such as sliding scales and so forth. But again, this is a conversation you should have with your representation to understand what your rate is, how you're rated. We provide our clients with what we call calculators so that they can, and we make it simple. We could put the contract value in and you could know exactly what your rate is. Now, there will be sometimes fees associated with your bond program that you need to understand. For example, there is a program from the SBA, the Small Business Administration, that has a bonding assistance program, and they have fees that are on top of your premium charge. Okay. Now, these are generally very small fees, and they're often very much worth the assistance because they're helping you get bonds that you otherwise wouldn't qualify for. So, for example, the SBA has a 0.6, so just slightly over 0.5%. And that is charged against the total bond value. See, I have a question. I'm going to answer that question in just a second. So you will have to understand if there are any fees. Now, there are other sorts of conditions to bonding sometimes, like for example, funds control or otherwise known as escrow. Those could have fees. So whenever you get a bond program, you want to make sure that you are understanding that your agent is transparent with all the costs associated with your bond up front. You don't want that switch and bait. You bid a job, you think your bonding program is this, and you get a charged a different rate. Okay. So you want to make sure that you have all those costs up front. Otherwise, you won't be prepared. So I have a question before you could put my, that sums up my presentation today, but I have a few questions. So hopefully you understand a better terms of the subject. Now, what is bonding capacity? Who will request this from a contractor like this? And how does bonding capacity limit our bidding capacity? That's an excellent question. So bonding capacity is generally what is your single job size that you're able to bid? So once we review your bonding program, we establish what is your general size of the bonds you could bid. So say, for example, that you have performed jobs in the $1 million range and you're ready to move on. We might establish a bond program, again, depending on not just your capacity, but your capital. Let's say we decide your bonding program is 2 million single. Your bonding capacity might be a 2 million single job size, and we might determine that you can have multiple jobs at once, and your overall aggregate, that's the total amount of bond capacity that you have, is 5 million. Okay, that's a work program capacity, not just a bond capacity. Now, this gets a little in the weeds here because that is also a very moving target, because it is based on the cost to complete and not the contract value. So that can be a little bit convoluted. Now, who asked for this? The SCA and the MTA, DASNY, many times you're doing a pre-qualification and they're going to ask you what your bond capacity is, what your single job size capacity is, and what your aggregate program is, and what your available program is. So let's say you have a 2 million single and you have a 5 million aggregate total work program, right? But you've used a bond already, and so you only have available 3 million. So that's how that capacity works. I hope that answers your question. If not, please, again, feel free to book an appointment with me in the subject line. So the cost of bonds is 1 to 3% assessed both on material and labor. Yes, so the cost of bonds is assessed on the total contract value. So you enter into a contract with the SCA and you are bidding a job and they award you the contract for $2 million, right? Well, in that $2 million, you are going to have your cost, your subcontractor's cost, your material cost, your labor cost, your profit, your overhead, your general conditions, everything. The bond premium is established on the contract value, and it doesn't matter how that is made up. It is the total contract value. Okay, Jeff, you can take off my, thank you. So I hope that answered the questions. Again, if it didn't, please continue to ask. I'd love to clarify. It is 10:59. I don't know if we're shutting off exactly at 11, but again, you have my links to post any questions. You can book an appointment with me. It is free. There's no obligation. We are open to help as a part of NYMAC, any of our clients here. So we would love to be of assistance to you. If that is it, it really concludes our program for today. Anybody have any last minute questions? All right. Well, that concludes the program for today then. I hope you got a good sense of what bonding is, what's entailed, how to establish your bonding. And I hope we have provided you some really valuable tools and information in our financial terms, in our 3 C's of surety, and so forth. let's see, I got, let me see. Yes, so I am glad somebody asked me, how do you increase your bonding capacity? And as we go along, I try to incorporate how to increase your bonding capacity by providing additional information, giving your agent broader knowledge. It is different for everyone. Okay. Sometimes it's just a matter of having a good agent. Okay. A good agent. I had a call yesterday and I have a client who, I'll give you this brief example, who's a fencing contractor. And he said, I've provided fencing, I have $1 million contract for fencing, but I was just declined on a $2 million project because I haven't gotten that far yet. I'm like, it's a fence. It's not any more complicated. It's just more of. So he was like, you get it. Like you can provide, you can explain that and you can encourage the surety company to get us broader. And I'm like, yeah, it's a fence. Whether you're providing, 2,000 square feet of fencing or 5,000 square feet of fencing, it's not any more complicated than it was for a smaller job, right? But it also might be encouraging you to take other steps. It might be changing your bond surety market because some surety companies are more aggressive than other surety companies. There could be it might be increasing the information that you give them, increasing your financials, upgrading your financials to a CPA financial presentation to give the surety much more assurance. I really strongly suggest you book an appointment with us to discuss your individual needs and how we can help you or advise you on how to increase your bonding. That's the best thing that we could do for you. So thank you very much. Anybody else have a question? Jill, I think we are
all set. Thank you very much. Thank you everyone for joining.
Thank you. Thank you. Thank you. I really appreciate it. I hope everyone got a good sense of information. And again, I'm here if you have any questions. Have a great day, everyone.
Thank you. You as well, too.
All right. Very good. Thanks. Bye.
Thank you.
You're very welcome. Thank you. Bye, ladies. I'll see you soon.
Bye.